last in, first out LIFO. This method is not acceptable by IFRS or Canadian ASPE. However, US GAAP allows using it. Let's assume that the business bought 5 units at $10 each in the first purchase. In the second purchase, it purchased another 5 units for $12 each. The business sold 3 units. What is the cost of the units sold? Since the business is using LIFO, we will assume that the 3 units sold are the 3 units that were purchased last. The word assumed is important because irrespective of the physical units that are sold, we are still going to assume that they are coming from those units which were purchased last and will cost $12 in this case. So if we return those units back to the warehouse and brought another 3 units out, they are still going to be valued at $12 each. Accordingly, cost of goods sold equals $36. So what's left in inventory? 2 units from the last purchase at $12 each and 5 units of the first purchase at $10 each. Total inventory is $74. Notice that the cost of goods sold is valued at the higher cost, which is close to the recent market prices, while the inventory is valued mostly with the cheaper cost of the beginning inventory. This is of course assuming that we're living in an inflationary economy. Let's assume that the business sold another 3 units. How are we going to cost them? We are still assuming that they came from the last purchase, and when the quantities from the last purchase finishes, we will start withdrawing from the first purchase. If you remember, we had 2 units from the last purchase left. So we assume that they are sold first, and then we will release another unit from the first purchase, leaving 4 units in inventory for $10 each. Cost of goods sold is now $70. Let's now take an example to apply this costing method on both periodic and perpetual inventory systems. A business has beginning balance of 5 units for $10 each. Accordingly, the period started with 5 units. In the periodic system, we just record the units at the beginning of the period and the units purchased. We don't keep record of the units that are sold. The business has beginning balance of 5 units for $10 each. On May 10, it purchased 10 units for $15 each. On September 28th, it purchased another 10 units for $20 each. The business took a physical count and found that there are only 7 units left in the warehouse. Here is a summary. Beginning balance of 5 units for $10 each. On May 10, it purchased 10 units for $15 each. On August 14th, it sold 11 units. On September 28th, it purchased another 10 units for $20 each. On November 5, it sold 7 units and didn't do any further transactions regarding this product till the end of the period on December 31st. Let's calculate the goods available for sale to derive the goods sold. The goods available for sale is equal to the beginning inventory plus purchases. In our example, the beginning inventory is worth $50. The first purchase is $150 and the second purchase is $200. The total number of units available for sale is 25 units and their value is $400. Since the ending inventory is 7 units, we can derive the goods sold by subtracting the ending inventory from the goods available for sale. It is equal to 25 units minus 7, which is equal to 18 units. So the business sold 18 units. Since we are using LIFO, then the last units that came in are assumed to be the first sold. So the 10 units which were last purchased are sold, followed by the 8 units from the first purchase. This leaves an ending inventory of 2 units from the first purchase and 5 units from the beginning inventory. Accordingly, the ending inventory is equal to 5 units times $10 each and 2 units times $15 each, the sum of which is $80. The cost of goods sold is equal to $320. Let us now see how we are going to cost the goods using the perpetual system. In a perpetual system, we keep record of all the flow of goods, whether buying or selling. Each single inventory item has a page in the inventory subsidiary ledger. It looks as follows. The main three categories are purchased, sold, and balance. So we started the period with a beginning balance of 5 units costing $10 each, so this will be recorded in the balance with a total value of $50. On May 10, there is a purchase of 10 units for $15 each. Such information is recorded under the Purchases section as follows. The total value is $150. It is the result of the multiplication of the number of units by the units cost. Now, the balance is composed of two layers, one representing the beginning inventory and the second represents the May 10th purchases as follows. So although there are two layers, we know that we have a total of 15 units for $200 in inventory. On August 14th, the business sold 11 units. This is recorded under the sold section. Notice that we are using LIFO. We are going to assume that the 10 units from the second layer from the last purchase with a cost of $15 each are sold first, and then 1 unit from the beginning inventory at a cost of $10 each. This leaves a balance in inventory of 4 units at $10 each. The total number of units sold are 11 units at a cost of $160. On September 28, the business purchased another 10 units for $20 each. This is recorded under the purchase section like this. Then, under the balance section, we are going to update the balance. Since the new purchase is at a different price, we are to form two layers. The first is 4 units at $10 each, and the second is 10 units at $20 each, with a total value of $240. On November 5th, the business sold 7 units. We are using LIFO, so under the sold section, the 7 units of the second purchase should go first at a cost of $20 each. This leaves the ending inventory with 3 units from the second purchase at $20 each and 4 units from the beginning inventory at $10 each. At the end of the period, cost of goods sold is calculated by adding all of the value column under the sold section, which is equal to $300. The ending inventory represents the last figure in the balance section, so it is equal to $100. Notice that when using LIFO, cost of goods sold and ending inventory in a perpetual system are different from those calculated using the periodic system. This is because the timing of the sales affects the cost of goods sold in the perpetual system, while in the periodic system it is assumed that the sales happened at the end.